And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, the second best day of the week, and that also means that Michael Lebowitz is joining me this morning as well. We've got a lot of stuff to talk about today. Obviously, Nvidia reporting earnings last night, just pretty much killing it across the board, despite the fact that there's lots of concerns about an AI bubble and credit default swap spreads and all this stuff. It's like the end of the AI bubble and stocks pull back a bit. It's interesting because, again, if you take a look at NVIDIA's reports last night, there's no slowdown in what's going on in AI development. So, again, they just kind of laid it out. They said, look, we can't even keep Blackwell chips in stock that they're going out the door so fast. So, again, yeah, there's always two camps to every side of an argument, but NVIDIA certainly says right now, at least from an earnings front, is that there's no slowdown evident yet. And they continue to beat estimates, handily each report. They've grown revenues to $110 billion, pretty incredible across the board. Walmart also announcing earnings this morning before the bell. Two interesting notes from them. Actually, they beat on both headline revenues and estimate and earnings. They raised their guidance for the rest of the year, and they made the note that wealthier customers are actually driving their sales. Now, we already know that from just taking a look at kind of the breakdown of the economy, that the top 20% of income earners are lifting about 50% of the total trade that goes on in the economy, consumption. About 20% is driving 50% of that. So again, not surprising, but it does say a couple of things, right? Even wealthier consumers are now stepping down into lower price stores. So again, the price, as prices have risen and as things have become more expensive, even wealthier consumers are now stepping down. Maybe I used to shop at higher end stores. I used to go to Whole Foods now, but maybe I go to Walmart, right? That type of thing. So you're starting to see that shift, noting that the wealthier consumers are driving their revenue growth. They're also announcing they're going to move on December the 9th. Walmart is shifting from the New York Stock Exchange to the NASDAQ. It's kind of an interesting, point. I'm not sure exactly all the reasonings why, but again, inclusion in the NASDAQ will be kind of an interesting take for Walmart. So we'll see what happens there. Outside of that, though, also today we will get the September employment report. So again, this is 2 months old. Probably won't tell us much of anything. The Bureau of Labor Statistics has confirmed they will not release the October report because they were not able to collect the household survey data. So there will be no October report. So we'll have September, and then once we get into December, in the next couple of weeks, we'll get the November report from the BLS. Now again, that'll kind of lead us up. We'll get that employment report just prior to the Fed meeting. Speaking of the Fed meeting, something we'll talk about with Michael Lebowitz a little bit this morning, the odds of a rate cut in December have now fallen below 30%. We're about 25%-ish right now for a rate cut in December. So again, a rate cut by the Fed at this point may be a surprise to the markets if they actually get it, because the markets really aren't expecting that very much at all. So we'll see what that employment report today says. Again, it's September data. It's very old. We've seen other data come out. So again, I don't think that's going to really move the market much. As we talked about yesterday, given that NVIDIA makes up 8% of the overall S&P 500, that's going to be moving the markets today. NVIDIA this morning's up about 5% after their earnings last night. And again, that kind of leads us to what you need to know before the bell. So, talking about markets in general, markets have been under pressure as of late, mostly in the technology space, because again, it's been this whole concern about valuations and again, credit default swaps and all this stuff with AI. Is the AI trade over? And markets had a bit of correction. And I've warned you over the last few weeks. I've said, hey, be careful. When we get a correction in the market, it's going to feel a lot worse than it actually is. So the market's down about 3% from the peak. People are freaking out, acting like it's we're in a full-blown correction here. We've had a minor pullback here. Actually, a good pullback, a good healthy pullback for the market at this point, kind of sets us up now for the next 2 weeks, which typically tend to be stronger for November. We'll get another bout of weakness in early December as mutual funds distribute their annual gains, and you'll be set up for the year-end rally. So, technically everything is fine for the markets, but let's take a look at Nvidia, because that's going to be the market mover this morning. So this is a chart of Nvidia going back 1 year. So this is a 1 year chart of Nvidia. This was the April low that we had during the whole tariff kind of announcement. So again, despite the fact that Nvidia's had a little bit of a pullback as of late, you have to remember that back in April, we were trading below 100 on Nvidia, and we're currently trading right now around 186 as of yesterday's close. So again, it's been a very, very sharp move higher for Nvidia just over the last 6 months, really 6-7 months in particular. But again, not surprising, we had a very big spike up in Nvidia just about a month ago, back in October. We gave that back up. We got very overbought, very extended. That wasn't a surprise at all. Take a little bit of profits when that happens, and then you get a pullback here to support. And again, technically, there's absolutely nothing wrong with Nvidia at this point. It still remains in a very, very positive uptrend in the overall market, running right along the 100-day moving average. The 50 and 20-day have been good supports for those all along the way. So the bullish trend remains very much intact. The stock came down, touched the 100-day moving average, found support right there at the 100-day, and is now going to open up about 5% this morning after earnings. We got that sell signal, which gave us this recent pullback consistent with that, and we worked off a lot of that previous overbought condition. We're now oversold. So again, the setup here for an entry into Nvidia is actually good. So again, if you've been kind of looking for an opportunity to add Nvidia to your portfolio, add to your portfolio position, whatever, this is actually a decent setup, at least from a trading perspective, that we may get a rally here that lasts 2, 3, 4, 5 days, at least coming off this earnings announcement. So again, if we just kind of take a look at this kind of recent been building a very nice base here for this. We've got kind of this rising trend. So again, you kind of look at this, 200 is probably the target for a rally here near term. That wouldn't be surprising at all. That's not that much. I mean, you're 186 yesterday, so $14 is not that big of a deal. But you are set up here for a bit of a rally in Nvidia. But that also just kind of brings us over to the overall market as well. Again, as we just talked about the last few days, the market's been under pressure for sure. And that always leads to a lot of concern by investors, like, oh my gosh, what's going on? Markets are going down. I'm actually losing money. Again, want to keep this in perspective. Here is your kind of your April lows that we saw back in April. And again, this has been a very strong rise in the market. So this pullback here just over the last few days is not surprising. Again, just a bit of a correction in the market. It's about 3% in total. Just like Nvidia, we're coming down and we're testing the 100-day moving average, trying to find a bounce off of that. We bounced off of it a little bit yesterday. Markets are going to open up today. If we can close back above the 50-day moving average on the S&P 500 before Friday, that will negate that break and keep this whole kind of bullish trend intact. Now, if we don't, if the markets kind of open up today, then sell off again, which is certainly possible. Again, that 100-day moving average, which sits right now around 65.20, is going to be important support for the markets to kind of hold on to near term. But again, we are in a sell signal. We are working off, gotten decently oversold enough here for a bounce. We've had about 4 straight days of selling before yesterday. So again, we've worked off a lot of that, kind of that recent pickup in October that we saw. We've reversed a lot of that. And again, this is going to set us up now for potentially this bit of a rally. Probably back up to around 6,700, 6,750, somewhere around there on the S&P 500, over the course of the next couple of weeks. So again, we've got kind of a good setup here for near-term trade. I wouldn't be worrying too much. Be a little bit reticent about selling right here. If you didn't take profits previously when we were talking about it, I'd be a little bit reticent about trying to sell here. You're probably going to get a bounce for a couple of days at least. And if you need to rebalance risk in your portfolio, use that bounce to rebalance your risk. So again, that's just kind of what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Lebowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So again, markets were all kind of pre-positioning over the last couple of weeks. A lot of the sell-off that we saw for the last really kind of week or so was basically a lot of pre-positioning because everybody didn't know exactly what Nvidia was going to say. So kind of a big relief valve yesterday for the markets to put exposure back on. So again, that's why you're going to see the markets up today. Dow's up about 200 points right now. Now, having said that, again, this isn't a mad rush back in the market. It's not like we're opening up 2% on the index today. I mean, we're going to be up about 90 bips on the S&P this morning. So again, it's a nice rebound here over the last few days of selling. And again, you're kind of bouncing off support, which is good. That gives you an opportunity here. We're still on a sell signal. So again, there's still downward pressure on the market. So again, keep that in mind. Momentum is still negative. Breadth is not great. So this isn't an all-in bullish buy signal. But what has happened here is that we've got this kind of support for the markets in terms of this is the seasonally strong time of the year. You've got buybacks to a large degree, about $5-6 billion a day, supporting the markets. You've got position going into the end of the year. There's a lot of portfolio managers that are behind on the curve right now in terms of tech exposure. They're going to have to get grossed up. So there's some support here for the markets over the next few days. And again, because we're oversold enough, this will give us a bounce. Now, if the market is able to bounce and turn that momentum sell signal back into a buy, then that's going to give you a bit better run. If it doesn't, this may falter out in a couple of days. So again, this is what I'm saying. If you feel like you need to do something in your portfolio, use this bounce over the next day or two to make those changes, whatever it is. And I wouldn't recommend going to 100% cash, but if you need to reduce risk, rebalance your risk, if you were way too long, high risk exposure, et cetera, use a bounce to do that. Just be, just be opportunistic about how you make changes. So, all right, with that said, Mike, let's talk a little bit about, NVIDIA's earnings yesterday. Again, it was it wasn't a shock report, but it was a lot better than even Wall Street was expecting.
Yeah, they knocked it out of the park. There really was nothing bad in the report. They beat everything. Earnings, revenues, they beat they raised forward expectations, the whole 9 yards. So I think what's most interesting about the earnings report is actually not the report. It's the market reaction. Mm-hmm. And we're just in the middle of the market reaction. They reported at 4:30 or so yesterday afternoon. The market traded in the overnight hours, which is not the most liquid hours. Many investors can't participate in that. So we're going to open today at 9:30 and we'll see how it trades. The stock has gotten beaten up to some degree over the last, 3-4 weeks. Mm-hmm. And what I expect we'll see is some selling on the open. There are some trap longs that have been watching the market kind of fade. Nvidia go down more than the market. They'll sell. The question is, will people buy and support it? At which point we could have one of those days where we open up 5%, maybe we work down all the way down to plus 2%, and then it goes off. And That would be a good sign for the market. My concern would be if we end up the day up 1%. This is on Nvidia, by the way. Right. If we end the day flat, down, up a little bit, and a lot of the other tech stocks are all red, and the S&P's red. Where the market just says, okay, that's great, Nvidia, but we're still on our bearish little move here, and that's going to continue.
Yeah. And that could very well be the case. I mean, there are some legitimate concerns out there about the kind of the whole AI space, and again, it's also too a little bit. You have to be a little bit cautious because again, there's been a whole bunch of headlines about CDS spreads on Oracle and everything else, and they're like, oh, look at the CDS spreads on Oracle, and again, you're talking about a bankruptcy, default risk of like 1.5%, something like that on Oracle. So, again, it's we're in one of those phases. We had a huge, and again, I think it's important. We've had a huge run in these tech stocks just since April. Like I was saying earlier, Nvidia is up from 100 to 186 just in the last 6-7 months. So again, a bit of a pullback here should not be surprising for investors. Again, I think you have to come back and look at the fundamentals on these companies and say these companies are growing revenues kind of hand over fist right now, and there's nothing really showing that there's a risk to that revenue growth, at least momentarily. Again, there's no evidence that there's a slowdown. CapEx is getting cut. We didn't see any of that kind of commentary as of late. So again, I think it's important to understand is that while narratives are great and headlines are great for getting clicks and views, it's also just the fact that we really needed a correction. It's just been a very big run in a very short span of time.
Right. And actually, Lance, your point about Oracle and CoreWeave, we wrote about that. That's in today's commentary.
Right.
It's either out or it will be out shortly.
It's out now.
Okay. And what we do is we give a quick description of what CDS is, credit default swaps. And it's basically this. We'll go into it real quick because I see these headlines showing up more and more that the credit markets are pricing in this percent or that percent of a default. Really, what it is it's a derivative market where there's a buyer and seller of insurance. The buyer of insurance typically owns the debt or owns the loans, or they may not, and they're basically buying insurance against the default. If the bonds default, they get par value back. So they basically can't lose money on the bonds at a cost. Mm-hmm. And the sellers of insurance are saying they're not going to default. I'll take your money all day, and I don't think I'm going to have to pay you out. The problem, these markets are very good for hedging, especially larger companies with a lot of debt outstanding, and companies, because there's so much debt outstanding, there's good two-way flows. People that want insurance, people that want to sell insurance. Companies like Oracle and CoreWeave does have a lot of debt. A lot of it is in loan form, but those markets are not that liquid. So if there's a buyer of insurance, they can really spike the price and of the insurance. And some of that's going on. And you got very volatile pricing in the CDS markets. So like you said, the odds of Oracle defaulting are pretty small. The odds of CoreWeave defaulting are a little larger. But bear in mind, that's a company that's taken on an extreme amount of debt. They're not making the revenue yet. They're losing money. So some people are making a bet, not that their products may not be good, but that they just can't borrow enough money from the markets to get to the point where they start getting cash flow to pay off the debt. That's one of the general things, the fog hanging over the whole AA market. Where's the financing going to come from? And CoreWeave is kind of the poster child for maybe there's not enough financing. Is that going to affect Nvidia? No.
But it's very interesting though, because it's this question of is like they're only looking at this from a very narrow viewpoint, which is that these companies can only go to the bond market to get financing. And that is no longer the case because we have a huge private equity and private credit market that's going to be that will be doing a bulk of the heavy lifting on a lot of this financing, because there is simply, for these private credit companies, they are loaded with cash. They have trillions of dollars available of dry powder and nowhere to deploy it. So when a company like a CoreWeave or an Oracle or an Nvidia comes to market and says, hey, I need to issue debt, yeah, they can go to the public market, not a problem. But if the public market doesn't want to do it, the private equity market is going to be standing there, or the private equity and private credit markets will be standing there going, yeah, we'll do it all day long because we've got cash to deploy. And I think there's a lot of mistakes being made in the view that there's going to be no financing available because they're not looking at the total financing market.
Well, and there's a difference though between CoreWeave and Nvidia.
Right.
Nvidia will use the public debt markets all day because that's
Absolutely.
the cheapest source of funding. They don't need they have, first of all, they have cash flow. It doesn't really matter.
Mm-hmm.
But if they were to borrow money, it would be in the debt markets, like you saw Microsoft and
Amazon
or Meta and Google
Yeah.
hit for 55 billion a few weeks ago.
Yeah, and Amazon just
CoreWeave.
did 15 billion too.
Right. CoreWeave, on the other hand, is funded with 80% loans. So they are using those private markets much more than the public markets, and I suspect they will. The problem for CoreWeave is that they're not as liquid. There's a lot of money there, but they're not as easy to transact in, and they cost more. So, that's kind of the arena that a CoreWeave has to play in versus an Nvidia or Google or Microsoft or Meta.
Right. No, it's true. But like I said, it's just, there's a lot of people who's going, oh, there's just not enough money there to fund it. And it's like, I think, one thing about the financial markets, they're like consumers. Consumers will always find money to go buy stuff with. They'll come up with,
Right.
They'll go borrow against their car, their house, whatever. And, the financial markets are pretty much the same way. If there's not a publicly available market for something, Wall Street will figure out another market to fund it and to make money
Right.
off of it. So, and I think that's just a huge part that people need to remember is that Wall Street's here to make money. Wall Street is not here for you. They are not here to help you grow wealthy. They're not out there going, hey, this 5 times levered ETF, this is really good for you to make you money and help you retire. That they're just providing product to the markets, and if you're willing to buy it, great, because all they want to do is make money off of you. And the point is that regardless of what goes on, Wall Street's going to find a way to profit off of it.
Just like Las Vegas.
Yeah.
They're not there to show you a good time. They're there to take your money.
Yeah,
You may have a good time, but it's going to cost you.
Yeah, it was interesting because I was just talking about Bitcoin yesterday, and there's kind of an irony of what's going on with Bitcoin in particular, because Bitcoin's been under a lot of pressure lately. We've had about a 25% decline in Bitcoin, and we've seen a lot of people, been a lot of sells lately in Bitcoin through transaction wallets, et cetera. So there's been a lot of de-risking. If you take a look at the BlackRock Bitcoin ETFs, significant outflows out of that ETF. And so I was talking about yesterday, I was like, it's ironic, but it's also interesting. And this goes to the point about Wall Street is that, retail investor, you always have to be careful what you ask for, right? So retail investors were begging for ETFs for Bitcoin and cryptocurrency. And Wall Street was like, okay, if you want them, we'll give them to you. And they did. They provided them. But what retail investors didn't understand is that as soon as Wall Street came to markets with ETF, it gave Wall Street a massive advantage to basically short the market when they want to, because they can just short the ETFs. They don't have to short the Bitcoin. They can just short the ETFs. And that puts that price pressure during corrections and makes these drawdowns probably bigger than they should have been. But again, what Wall Street does is not always to your advantage. You want ETFs? Sure, here's an ETF. That's not your advantage. That's to their advantage because it gives them a whole lot of liquidity.
Let me rephrase that. It's always to their advantage. It may be to your advantage, but it's always to their advantage.
Right.
If they can make money and make you money, they'll do that. But they'll make money even if it means you losing money. So,
yeah.
Always keep that in mind. But the interesting thing with Bitcoin is the true believers of Bitcoin, I can't imagine would ever buy the ETF, right? You buy the Bitcoin.
Right.
You have it in your wallet. That's the purpose of Bitcoin. It's decentralized. It's not in the system. ETF is in the system. So you're attracting all these, traders that just want to trade it, buy it, sell it. So that can be good, but it creates a lot more volatility than you were going to have before, because you have a lot of people that are not really true believers. They're just in it to make some money, and they'll be very quick to get out of it. They can now short it. There's a lot more ways to trade it, and you have traders trading it, not true believers. And
right.
that has kind of cheapened the customer base, so to speak.
Right. Well, and again, that's what I'm saying is the idea of cryptocurrency was great, because it was going to decentralize things. It was going to be this kind of off-market asset that is, not going to be affected by everything else. And then, of course, as more and more people wanted more and more adoption of it, it's become kind of a Main Street, process now through Wall Street. Again, you got ETFs and all kinds of other instruments that are being spun off of that. That again gives Wall Street the ability to arbitrage trades, take advantage of, upswings and downswings, take advantage of, and what Wall Street loves is volatility, because if there's volatility in something, that's where they make money. And so you've now created this, all these things that you beg for now create the volatility in the markets that is a huge advantage to those that are actually trading the positions. And my question though, Mike, is interesting, is that, there's been a huge rise in Bitcoin. I'm wondering if that as this gets more and more adopted by Wall Street, do we simply just arbitrage out the gains eventually?
In Bitcoin, yeah, like everything else, that's what's going to happen. And it seems like Bitcoin is slowly just being swallowed into the centralized financial markets, capital markets, right? Stable coin is really owning US dollars. It's all backed by treasury bills. So the whole concept of, I think, what people bought into is slowly fading. And then it just becomes a trading instrument, just like we talked about CDS. Yes, it is insurance, but it's also very much a trading instrument. And a lot of people buying the insurance or selling the insurance have no exposure to these companies. They're just gambling or, betting, making educated bets in some cases. But nonetheless, I think it's just Bitcoin is just becoming part of the investment menu along with everything else. And it's not what it's, what in theory, what it's set out to be.
Yeah. It's just interesting. This is just how markets develop over time, and how this eventually ends up, who knows? But we actually have one of the founders of DeFi Development coming to our economic conference in January 17th, and they trade on the NASDAQ. DFDV is their symbol, but they do a lot of work with Solana. So they'll be actually coming to talk about cryptocurrency, kind of the future of it, kind of what to expect, and kind of what they're doing, and looking at these treasury companies, et cetera, that have been developing. So it's going to be a really good conversation. Super smart guys that started DFDV. And again, Brian Dunlap from BlackRock will be there to also talk all about AI. So again, if you haven't got tickets yet, ticket prices, the tickets are on sale right now. They will sell out pretty quickly. We sell out every year for this conference because there's very limited seating. It's only about 120 seats. So they are going to sell it pretty quickly. Tickets are $199 plus taxes and fees. I got an email yesterday. It was like, it's $233. Yes, it's $233. Taxes and fees. You're going to pay taxes. You got to pay fees to the ticket vendor. So it's $233 total for a seat. There's also a mixer the night before. If you want to come, we're going to have a mixer with all the events. It's a very small event. There's only about 10, 20 seats available for that. So when that sells out, that'll be done. But the night before, on Friday night, Adam, myself, Mike, Brian Dunlap, Daniel King, they'll all be there. You can just hang out, talk, visit. There'll be kind of heavy hors d'oeuvres and drinks, and we'll just be talking to everybody. So it'll be a really fun event for a couple of days. But if you want to come in, we do have a block of rooms available at the hotel. It's Hotel Sonesta here in Houston. So if you want to fly in, great. Love to see you. We've got discounted rates on hotel rooms as well. So anyway, so let us know, and I'm happy to take you. But go to the website, realinvestmentadvice.com, click on the banner, and make sure and get your tickets before they sell out. Also, the price will go up as we get closer to the event as well. So Mike, let's switch gears here a little bit. Talk about how the Fed controls liquidity in the markets. I've had a couple of conversations about this as of late with different people. And again, just talked to Garrett Baldwin here recently, just talked to Brenton Johnson as well, just recently talking about the dollar. By the way, totally forgot. I meant to mention this morning on before when we were doing our before the bell commentary. The dollar has now broken above the 200-day moving average. Mike and I have been talking about for a while that we would very likely see a counter trend rally in the dollar because it was so oversold. It's been very quiet, but the dollar starting to rally. We're back above 100, which is fair value for the dollar, and broke above the 50 and the 200-day moving average. So technically, there's a very nice move going on. There's still a lot of short positions on the U.S. dollar. So again, if those dollar shorts have to start covering, that's going to push the dollar rally higher, and that will obviously impact assets that trade in dollars, negatively, right? So a stronger dollar makes those, purchases of those assets more costly. So it tends to have a negative correlation to assets that trade in dollars. So, but anyway, just kind of an interesting byproduct in the background of what's been going on with the dollar lately, just very quietly having a little bit of a bull rally. So, but Mike, talking about, I've been talking with a few people lately and we're going to have some upcoming interviews on this, but talking about Fed liquidity, we just recently kind of talked about, kind of how the market works. In last weekend's news, I talked a little bit about the repo stress. And so you kind of wrote this article this week talking about how the Federal Reserve actually supplies liquidity to the financial system. So let's kind of dig into that a little bit.
Yeah, so it really stemmed from last week's article where I talked about what's changed since basically 2008. Why is it's answering the question, why is the Fed always in the markets now providing liquidity? It was never like that before 2008, except on rare occasion. Now it just seems like, there's like what we're seeing today. They're stressing the liquidity markets. The economy's fine. The markets are doing fine. Why is there stress in the liquidity markets? And that has kind of become more and more common since 2008. And the prior article kind of talks about how regulations have changed the playing field and taken it away from the overnight funding markets, away from the private markets and into the hands of the Fed. So I got a couple questions from readers that say, can you better explain how they do that? What tools do they use? So I thought it would be a good opportunity to kind of walk through how the Fed does what they do. And essentially, they do it all through their balance sheet, whether they're taking securities in and putting liquidity out or vice versa. QE, QT are the most well-known. Quantitative easing, quantitative tightening. In quantitative easing, they're buying securities from the banks, and in return, they're giving the banks reserves, not cash, reserves. QT is the opposite. The problem with QE and QT is that they're very blunt tools, and they're on a set schedule. So if you're doing QE or QT, they're on a schedule. So they may say, we're going to do 50 billion a month. That means they're providing or taking away 50 billion of liquidity every month. Prior to 2008, all the Fed cared about was getting the Fed funds rate to trade where their target was. When you have a tool like QE, QT that's constantly adding or taking away liquidity, it's not helping you to target Fed funds the way they used to, where they would just buy or sell every day. Some days they would go in, they're in open market operations, and they would buy 10 billion, turn around the next day, sell 20 billion, and they were doing that to provide liquidity or take away liquidity from the markets to get them to trade the overnight Fed funds rate to trade where they wanted it to trade. Since then, they've created a bunch of facilities, for lack of a better word, that have created what's called a corridor. And the corridor is a floor and a ceiling on Fed funds. So, and we don't have to go into details on what all of those instruments are, but essentially what it does is it keeps Fed funds within a range, which is what the Fed wants. It has basically lending facilities when Fed funds get too high, and facilities where investors can invest their money when it gets too low, and it keeps Fed funds about where they want it. But in the process, what it's created is a signal to the market. When these rates get disjointed from where they should economically, what financially makes sense trade, that's how you have some stresses going on. So one of the things that I point out is there's what's called the SOFR rate. That's the securitized overnight financing rate. That's where the private market just trades overnight, securitized with treasuries. So it's basically risk-free repo trades. And then there's interest on reserves that the Fed pays the banks. SOFR should never really get above the reserve rate that banks are getting paid, or banks should lend via the SOFR markets, but they're not. So what's that telling us? That banks won't earn more money lending on a securitized basis. This goes way back to 2019 when we were talking about this, Lance. And basically, it's telling you that there's stress in the market For whatever reason, the banks are not willing to lend on a collateralized basis at a higher rate than they can earn money from the Federal Reserve. So this corridor system, in theory, should work, but as we find out in the markets, there's always stresses, whether that's because banks just don't want to lend money because they have capital issues, whatever the issue may be, these corridors that they've set up are also alarms for us to use. It's also important to recognize that, first of all, not all liquidity comes from the Fed. There is still private market liquidity trading, so to speak, but there's also the public sector has an impact on liquidity, right? When we deposit money into a bank, we are creating liquidity for the bank. Loan demand, banks' lending policies have a impact. Economic conditions that, as we've seen, the federal deficit can have a big impact. It's taking liquidity from the market. And then very recently, the Treasury General account. During this whole shutdown, the Treasury General account got up to almost $1 trillion. So the Treasury has $1 trillion basically of liquidity just socked away at the Fed. And you put all that stuff together and you get a fluid, pardon the pun, but you get a fluid liquidity situation with this system of corridors. So, you can go read the article, but and it may be very confusing, but I think that the biggest takeaway from this article and the primary article is that the Fed is the provider of liquidity, and to understand the markets, and I'm not just talking about bond markets, I'm talking about every market, stock market, Bitcoin market, gold market, even the commodity markets, they depend on liquidity. That's one of the big drivers of price. So if you want to understand where the momentum is coming from, it's coming from the liquidity markets, which is coming from the Fed. So that's why we spend so much time talking about the Fed, doing a lot of research on our own about the Fed, what they're doing, what they're thinking, why we care so much about what they may or may not do at the next meeting, and what each member is thinking about. So it's all pretty critical in the process. So
go ahead.
Go ahead.
No, that's fine. Go ahead.
No, I pretty much rambled on. Go ahead.
Well, no, but this is kind of the point. I mean, is that there's an important linkage here between, how liquidity in the system works. Again, and we are a fractional reserve banking system. So, this creation of reserves is a very important aspect to the functioning of the system. Because again, there's, as you were talking about, all money is lent into existence. So again, if you're going to create any type of money into the system, it's got to get lent into that system. So this whole liquidity issue becomes very important overall.
Yeah. So, and again, we talk about reserves, and the reason I talk about them so much is because that's kind of the footprint that the Fed's been there. Not all their lending is to the banks, but every time they lend with a bank or transact with a bank, it's done in reserves, securities for reserves, lending for reserves, or invest. When a bank's investing, it's reserves are involved. So while it's not 100% with the banks, the reserve levels in the banks provide us a very good idea of what's going on at the Fed, and not surprisingly, when reserve levels have dipped recently, we knew that there was stress problem, right? We've talked about this 6 months ago, Lance, when the Fed had the overnight reverse repo, which was a facility to take extra liquidity. 6 months ago, when this thing was starting to dwindle down, we said, buckle up, there's going to be some liquidity stress entering the market. And sure enough, as that thing got close to zero, there's liquidity stress, and reserves are still falling. And that's, the Fed stopped QT. They're going to do QE. I know it sounds crazy right now because the stock market's fine, the bond market's fine, the economy's fine, but the Fed is a lot closer to QE than anyone thinks. And as we've seen, QE can have a big impact on the markets. So pay attention. The Fed, whether we like it or not, as free market guys, me and you, Lance, we're not thrilled with this, but it doesn't matter. That's the game we have to play, and it's from an economic point of view, it's not good because it basically they're interfering in the transaction market and capital markets, and it's a tax, but that's the game.
No, this is absolutely right. I mean, and so the question in today's poll is, which Fed liquidity tool do you think has the biggest impact on the markets today? So SRF, the standing repo facility, the overnight reverse repo, So on RRP, I actually put that in there twice. I don't know why. And the Treasury General Account, TGA. So which one of the three? So right now they're evenly split. It's about 28% for the standing repo facility, about 49% for reverse repo, and about 25% for TGA. So which one do you think has the most impact on the markets of the three?
I think the standing repo facility is probably the most important. That's the one that keeps a cap on borrowing rates. It's not being used necessarily, but I think having it there keeps the markets calm about liquidity, that they know there's a backstop. So while it's not the most used of those, I think it's having the most sentimental effect. The most, it's like an insurance policy. They know the Fed is there. So that's my vote. But
yeah,
I could certainly make a case for the other ones as well.
But they're all important, right? They all play into it. So that's really kind of the big issue. So, all right, well, Mike, we had good reports from Walmart today, good reports from Nvidia today. Markets are looking good today. So Nasdaq right now is trading up about 400 points. So, what do you think? Near-term market bottom, maybe get a bit of a rally here?
Again, after we get past that first hour, I think the market may fade a little. I want to see what happens after that fade, if it can kind of regroup and then go on to new highs for the day. I think that would be positive. And then maybe, then the next test is, can we get a higher high? That would be very bullish. What concerns me is if we don't get a higher high, we rally, even if it's for a week or two, and we don't get up to the prior record, and then we start fading and we set a lower low. So, there's a lot of possibilities out there, but that's what we're watching.
Yep, there you go. All right, well, that wraps up the show for the day, and we'll be back tomorrow for Financial Fitness Friday. Next week, we've got a whole slew of really great interviews for you. We've got Parker White on Bitcoin on Monday, Garrett Baldwin on Tuesday, talking about a little bit more about reserve creation, how banks work, money in the system. Peter Atwater on Wednesday. So got some great interviews for you next week here on the Real Investment Show, so you don't want to miss those. And then have a great Thanksgiving next week as well. It's going to be lots of stuff going on. Anyway, have a great day. Be back tomorrow, of course, for Financial Fitness Friday. Be sure to like and subscribe to the channel. We'll see you then.